Okay, so hi everyone, a very good evening. How are all of you doing today? A very warm welcome to another episode that we have lined up for you in the AIKI series of India Karega Invest. And thank you so much for joining in. Guys, we're just going to wait for maybe another minute or so before we get started. We're just waiting for some more people to join in, but we already have a reasonable number, but we're just going to wait for another minute. So yes, hi guys, hi Sanjana, Ganpat, Mukesh, I can see all of you. Hi, good evening, hi Deepak. Okay, so yes, just another minute, and I think we'll start. Hello Hemant, hi Sitaram. I have a lot of you on the call. Okay, great. I think we can get started. So, a very good evening, and thank you so much for joining in. I'm Namrata here, and today we brought another wonderful episode for all of you in the Ab India Karega Invest series. So today we are going to talk about investment opportunities in the infrastructure investment space, and this is, I think, a space which a lot of people are interested in. Something that infra is one of the themes, one of the one of those categories of funds or stocks that a lot of people are interested in. So today we are going to talk about infra as a theme in detail. And of course, with us we have Mr. Sanjay Doshi. So he's going to be our main speaker for today. So before we get started, I'm just going to quickly introduce Sanjay to all of you. So Sanjay is basically a fund manager at Nippon India Mutual Fund, and he has about 16 years of experience in equity research and fund management. Before he joined Nippon India, he was working with companies like Macquarie Securities and JP Morgan. He's a qualified CA, CFA, and an MBA from NMIMS Mumbai. So thank you so much for joining us, Sanjay, today. And so we're just going to quickly, I'll introduce the theme, and then we'll have Sanjay take on. So when we talk about infrastructure as a theme, I do believe that infrastructure development truly is the backbone of any country's progress. And there's a saying that for every 1 rupee which is spent on infrastructure, about 2.5 rupees comes back to the economy because of the kind of sectors and the because of the kind of support that infra provides to multiple sectors. And I think even to understand the trajectory of economic growth of a country, we look at elements like performance of the housing market or automobile sales, and all of them are integral parts of the infra team. So today we are going to discuss in detail. We're going to try to understand what really lies ahead for the Indian infra space, and for that we're going to call on Mr. Sanjay to help us understand the same. So Sanjay, over to you. Thank you so much for
Uh,
joining again.
sure. Thank you, Namrata, and very good evening to everybody on the show now. Uh, to begin with, I'll share a few slides. I'll make a small presentation. My presentation is divided into three sections. The first section is more about understanding the importance of infrastructure cycle and what we have our view in terms of the outlook for the space. The second is more about what we have learned from the past cycles and how that could be looked at for the upcoming or the current cycle in our view. And lastly, we have a few slides on our product offering in the space, which is a Nippon India Power and Infra Fund. So before I jump into my sector outlook, I'll just like to spend a minute on the slide which is visible. It's a very simplistic slide to give you some idea about investment cycle. When we talk about infra cycle or investment cycle, this particular slide gives you an idea of what we have seen in the last 20 years or 2 decades. Very clearly, there are a few things to be noted. One is there are a period of 3 to 5 years when we have a certain section or certain leg of the cycle, whether it is an up cycle or a mid cycle or late cycle and then a down cycle. And more importantly, we should appreciate what really goes into making of this cycle. So this particular slide gives you some idea, though it is not an exhaustive list, but important factors when we look at India's infrastructure investment space. According to us, the key factors which really drive a cycle are government reforms. So the last major cycle which we had was led by government reforms on the power generation space. Uh, uh, Today, I mean, what we have seen in the last 4 5 years in terms of reforms for formalizing of economy and many other steps, which I'll try to cover, it is actually supportive of the cycle. There are factors like what is the utilization levels across various end user industries, whether it is automobiles or cement or steel, oil and gas, all capex intensive industry. What is the utilization levels, which actually leads to the next cycle in terms of new investments. It also depends upon the availability of financing for capex. So obviously, it is leverage business. So you will have borrowed funds which should be available at a reasonable cost for a time period for companies or entrepreneurs to be able to make the next investments. Factors like the commodity cycle or real estate cycle, as Namrata also pointed out, those also really play an important role. The profitability of these companies, the cash flows from these companies in these sectors really led to the next cycle. Um and also the overall sentiment in the economy. I think some of these are the factors which we believe really drive a cycle. And to our mind, we are already seeing positive divergence for almost every space that I talked about. And to top on of it, there are many factors which are new, which happens almost in every cycle. To our mind, the energy transition will be one such area, or the production link incentive, and efficiency related capex. What we learned from COVID in terms of automation and digitalization, these are the trends which will again support the next cycle. So, just to give you a broader view of how cycles actually get formed, and to our mind, we are just at the beginning of a new cycle. The last part of the slide also shows you that the last 7 8 years there have been a major downturn in capex in the infrastructure space, and now we probably have turned over here. Um, uh, our basic thesis on the sector is that we should be able to see at least 12 to 15% compounding growth for the next 4 5 years, or maybe even a longer period of time in terms of overall spend. And it boils down from the government side itself, which probably account for around 70% of our overall capex. It has actually moved up to 80 85 in the last few years. But what we have realized is that government has finally acknowledged the importance of having a development for the economy led through infrastructure creation. As Namrata also pointed out, it actually has a multiplier effect, probably even closer to 3 times if you have the technology improvement also happening at the same time. It also has a potential of generating a lot of employment, which is very critical for an economy like ours with a young population. Uh, and it actually creates long-term assets which improve the productivity of the economy. So if you want to place our economy in competitive positioning across the globe, I think what is critical is that you improve the logistics cost or the power cost or the ability to do businesses, and that is all directly linked to infrastructure, which is there in the economy. And when we talk about this infrastructure, I think it will be wrong to just limit it to physical infrastructure. We have seen importance of social infrastructure, whether you take health institutions or healthcare institutions. Again, COVID really gave us a shock about how important those infrastructure is. The educational institutions, and also the digital infrastructure now. That is also very critical if you look at it from a long-term perspective. And we see all of these being in a positive frame. Um, After the central government, we see state governments which actually derive a lot of their resources from center. They also have witnessed significant pickup in their capex. And to my mind, we have already seen the first leg of good private sector capex. While most will still believe that we are still a couple of years away, to my mind, we have already seen the first important leg of private investment coming back. And the next 3 4 years, it is more critical to look at the private space in terms of their spending. And we are seeing it from micro level data also. When we look at all the companies that we cover, the 300 plus active coverage that we have, and the kind of commentary we get from the order inflow and the pipeline data for all the engineering and infrastructure companies, they are seeing new highs, lifetime peaks in terms of quarterly order inflows and backlog. And this is companies who have 70 80% dependent on private sector for their capex. They are also seeing this trend. So very clearly to our mind, even private is now in the fray, and the large capex from private will be seen in the next 3 to 4 years. I think it is important to spend a minute on understanding why we are so positive on the government side. As I mentioned, for a country like ours, government reforms have played a very important role in infrastructure spending and infrastructure development. We have seen the efforts made by the government to formalize the economy, whether it is GST, RERA, IBC, many other initiatives. What has really helped this process is the ease of doing business as well as the ability of government to generate revenue. So GST collection, even I believe last month collection are at a peak, and we have seen significant support coming in from these formalization initiatives done by the government to improve the revenues, and therefore they can allocate more towards infrastructure development. They have also given a very clear roadmap through the national infrastructure pipeline, which gives you direction for the next 4 5 years in terms of the focus areas, in terms of projects which are bottom up, in terms of the overall spend, which is again a mind-boggling number, 111 lakh crores plus, which is more than double of what India spent in the last 5 years. So that is a kind of target the government has set for itself for the next 5 6 years. Along with that, we have Gati Shakti project, which is the coordination of infrastructure logistics projects in a very holistic manner. We have seen the efforts being made on ensuring we get enough funding, which is being addressed to the national monetization pipeline initiative, which is very differentiated from a government thought point of view and more like a private thinking, where you try to monetize the amount that you have locked up in real assets once they are in a very risk-free state, and then churn that capital to create new assets. So that is what the national monetization pipeline is trying to do, which is what the private sector will also always do. So that is a kind of benefit on funding side. We have seen the developmental financial institution which has been set up for providing leverage to government resources. We have done enough to attract more foreign funds, whether it is global pension funds or we have sovereign long-term asset owners. All of them have seen enough support coming in from government side. We have structures like InvITs, REITs. The markets have developed for these structures, where even an existing assets, which is a better yield assets, can now be looked to churn the equity and create new assets. So the funding aspect is also being looked at today in a very positive manner. The government tried to revive the private spending also through tax cuts, which we saw, which happened almost 10% direct cut. And for new manufacturing assets, we have one of the lowest tax rate for in the region today. And most importantly, what we have seen is the production link incentive, which to my mind is one of the best efforts done by the government, where itself we can see 2 to 3 lakh crores of spending from the private side to get the benefit. And here it is not dependent on just intent. You have to actually give the output in terms of improved exports or reduced imports, and for that you need to invest first to be able to generate those output. And this is one of the best schemes where we have seen success in mobile phone, and now we have seen so many other areas which the government has given support, right from pharmaceutical, chemicals, autos, and now even new generation like semiconductor. You have battery technologies. All of these are getting PLI incentives, so that you have more confidence, and you get those incentives to compensate for your capital cost. And in the meantime, we develop our infrastructure asset base where our competitiveness improves. So these are the government initiatives which we believe are very strong. And lastly, we believe defense is one space where it is not well still appreciated, though we have seen some recognition now in the last maybe 2 quarters or so. But we believe it's a very long gestation period for defense industries, and the next few decades could be very positive for indigenous defense companies, which are trading at much below potential fair values. And a lot of efforts have been made to get those technology right, and we will see the benefit coming in the next few decades, in my view. So this was on the government side. On the private side, as I mentioned, we have seen utilization levels improve across most end user industries. In fact, cement metals, we have seen almost peak utilization coming in. And more than that, even the commodity cycle is very supportive of profitability and cash flows. And we have seen the assets being being utilized in a more efficient manner. And those kind of capex we have already seen in the last 12 to 15 months. We have seen brownfield expansion in cement, and now we are looking at greenfield expansion in most of the areas, including metals and oil, which is much more larger capex intensive industries. We have seen balance sheets of all the private companies also improve, either because of better profitability or because of the resolution of stressed assets, and this is going to support private capabilities to invest. Lastly, we have seen real estate cycle being very, very supportive. I think Mumbai recorded the highest ever bookings in the last month again, and we see this trend for last 4 quarters now, where there is gradual improvement in bookings, and now we have seen price hikes coming in real estate, and this is also one deep cyclical space which normally will have a 5 to 7 year kind of a cycle. So not only metros, we also seeing tier 2, tier 3 cities also seeing positive real estate pickup, and all these are having a multiplier effect on the capex spending. In terms of various subsectors, we believe the key focus area will be transport infrastructure, which is basically trying to improve logistic cost, and we are moving up the technology curve even on there with medium and high speed rail networks. We have more metros coming in. We see water as a good space. Energy transition is one area which will see investment happening in the next 5 to 10 years, whether it is coal or whether it is oil, where we want to diversify our dependence. And I think that will be a very important trend and give technology companies an edge. We see digital infrastructure being very heavily spent. Data centers probably will become 5 times of what we are there today, and that would be another big opportunity. Renewables, again, the matter of energy transition. Uh, COVID has also shown the benefits of digitalization and automation, and we have seen significant amount of growth in companies who have those technology edge. They are seeing 50% growth on an for the last 4 quarters in this space, and I think this trend is going to continue for the foreseeable future. So these are the subsector outlook from our perspective in terms of a positive view. Just to summarize on that aspect, we believe the current cycle will be now more private led, where PLI will be one more important factor, and commodity and real estate cycle are going to be very supportive. We see medium term trends of energy transition, which will be a very good opportunity for better investments and returns. Uh, and we see efficiency related capex going to be another key driver. Defense is another space where we have a differentiated view and differentiated positioning in our fund also. This particular section, I have just 2 slides which will try to give you some flavor about past cycles, and why do we think playing the cycle right is equally important in a thematic like infrastructure. Uh, so again, a summary on the top chart you will see is the cycle span. Normally, it is 5 to 7 years. In fact, the last down cycle has been more than 7 years, probably closer to 10 years. And so basically, a lull period of almost 8 to 10 years itself gives you enough room as your capacity utilization improves, and therefore the capex comes in, and then we have the added advantage of all that is being done from the government side, and what has happened on the real estate and commodity cycle side. At the same time, as I highlighted, this cycle will have added advantage of new levers like the energy transition and digitalization, and that is where we want to play. At the same time, it is important to understand there could be issues about certain end user industries which may have an impact on their terminal values, or you can say the investor perceptions about the longevity of those businesses. Whether you take it area like coal or oil, and we would be mindful of what can happen even if there is near term growth in terms of multiple compression. So that will be important to take care of. At the same time, at the other end, you will have those new segments, whether you take it hydrogen or EVs or digitalization. There, the multiples can keep on expanding as the growth can surprise quite meaningfully. The bottom chart gives you some flavor about what we saw in 2002 to 2008 period, which was the last major cycle in infrastructure or capex spend that we saw as a country. As you can see, the orange bars are the BSE Cap Good Index returns, and blue ones are the Nifty 50 or the broader market. And you can see those period of 2002 to 8, which is on the left side of the chart. The broader BSE Cap Good Index actually more than doubled on almost every year in terms of returns versus broader Nifty, and that is what really happens in an upcycle. If you get the cycle right, it is also very difficult to get the quantum of the upcycle right, and that is where the catch-up game happens. You also see growth having a positive effect on profitability and therefore the multiples. And I think that also keeps on expanding your return potential. After almost like 8 to 10 years, we have seen 2021 calendar year giving some signals from the market side about a potential new cycle. The BSE Capgood broader index has given more than double the Nifty return in calendar year 2021. So that is probably what the market is also sensing now. And to our mind, the cycles are normally 5 to 7 years, or maybe even longer. And we definitely see a potential of another 4 5 years of good double-digit kind of growth. Whether investors have been positioned themselves for the cycle, to our mind, again, there is a disconnect over here. We have not seen any improvement in flows in infrastructure theme products. In fact, the overall AUM of infrastructure theme products has declined in the last 3.5 years. This is a period which has been taken on purpose because we saw the peak of NAVs of infrastructure themes in January 2018 before the last fall and then the upcycle. And from that time till today, we have seen those funds have a AUM decline of 17%, while the broader AUM in equities is more than doubled. So that is a kind of disproportionate underperformance in terms of flows. And if you see the cycle coming in and returns going to be much better as we have seen in the past cycle, and there is a potential for having much better returns and broader cycle, broader markets, I think the flows will also come in. So that is our view on cycle and how investors can look at it from a upcoming cycle perspective. I'll spend a few more minutes and then I'll open it up. And this is more on our product, which is a Nippon India Power and Infra Fund. We had an improvement in our mandate in 2018, where it was earlier a diversified power fund, but now we have infrastructure as a broader theme. Power normally is around 25 to 30% of infrastructure spending. So now we have a much broader mandate. What we are trying to achieve in our product is obviously we want to capture the potential upside in the best possible way. But at the same time, we are very mindful of the volatility which happens in the cyclical space, as well as the volatility which comes in if you are wrong in terms of the companies or the subsectors when you're trying to play. So that is what our key focus is, to be able to participate in the cycle, but at the same time try to manage the volatility which can come in. We will definitely look at outsized bets, but it will be dependent upon our understanding of those companies, where the first important point is that these companies should be able to survive a down cycle, because that is the real pain point. And we have seen a lot of companies have issues about insolvencies in this space. So we'll be very mindful of balance sheet, corporate governance to an extent as possible within that space for our outsized bet. We would like to maintain a good balance between large, mid, and small cap exposure within the infrastructure theme. And this is to ensure a good liquidity and reduce volatility. We also strongly believe that even large caps gives you enough multi-baggers and over a period of time. And consolidation do work out in almost every subsector. And that is where we're also likely to see some of the large caps get the added advantage of technology and scalability. Today, if I look at the fund, we have a good balance. We have around 47-48% of large cap, and we have another 50% into mid and small cap in some ratio. And we'll be very mindful of our small cap exposures to take care of balance sheet issues. Our fund today has good exposure to various subsegment of infrastructure, and we do not have anything in the product which may not be classified within the infrastructure theme. So even we don't have any financials exposure as of now. We have a positive view, as I mentioned, on defense as an opportunity. Similarly for real estate and engineering is a bit overweight to take into account the transition, energy transition that we want to play, and automation, digitalization plays. And we have good exposure to cement, telecom, oil and gas, and other sectors. So this is a summary of our fund positioning as of today. So if you look at from March 2018 to February to 2022, again that period is because we got a change in mandate and we had a better exposure towards the infrastructure space. So we have diversified more towards a large cap versus a small cap, where initially our small cap exposure was close to 60%, and we had a very difficult time in 2018 with the investment sentiment being wrong and small cap having a downturn. It was very difficult to exit some of the position even if we wanted to, and that's what we want to avoid in any phase of the cycle that we want to play. So today we have, as I said, a good mix between large cap, mid cap, and small cap, and it is reflected in our average AUM or average market cap of the AUM today. If you see the pie charts which have been shown of March 2018 and February 2022, you will see the exposure being diversified to the various subsegment of infrastructure, which we now have an option versus previous where it was more a power sector fund. As you can see, we have bullish view on the engineering space. We have bullish view on defense, real estate, and power. Utilities is around 10%, and the rest 5.5% are companies which are directly linked to power generation or power distribution. So that is a rough view about our product today. We have logistics companies, telecom, oil and gas, cement, defense, engineering, power, metals. Again, not many commodity businesses. We will not have pure commodity businesses, whether it is oil, coal, or metals. We look at more value added companies, and we have some bit of exposure on social infrastructure with hospitals. So that is a broader framework, and these are the top 10 holdings and the top sector wise positioning today as far as our fund is concerned. There will be a good mix of small cap, mid cap, and large cap. You can see a few names which will be outsized bets, but we'll be very mindful of the balance sheet and the capabilities of these companies when we put it in an outsized bet in our portfolio. I think I'll stop here and we can open up for questions. Namrata, can you just
Yeah. Hi. Thank you so much, Sanjay. Thank you for all the wonderful views. And I was looking at your fund, division, which is pretty interesting, where there's a decent 10% allocation to defense, which is, pretty nice. So we have certain questions lined up for you, and let me just yeah. So let's take some questions which are there for you, and some of them are shared by the viewers, and we would like to get your views. I think you may have answered the questions in the presentation itself, some of them, but I think it's only fair to repeat and
sure?
reinforce some of those
Okay,
points, right?
sure.
So the first question is the GDP expectation has been revised downwards for the next year, which is financial year 22-23. And what kind of impact do we see on the infra theme because of this particular GDP impact?
Uh, I would not be reading too much into minor changes which happen at the GDP level. Obviously, it's a larger composition of many things, including the consumption of across various subsegments. But as far as infrastructure space is concerned, I think from the government side, we can look at nominal growth rate of 12 to 15%. In fact, the last budget had a much higher allocation, but if you even try to look at the nitty gritties and come to a more reasonable understanding of why the spending is happening, then
Mhm.
probably 12 to 15% from the government side is good enough. But I think, as I pointed out, what we are now in the stage where private is coming back in a very meaningful way. Just to give some sense, government had become 80-85% of capex as an economic basis, and normally the ratio is 70-30. So there was a lull from the private side, and we have seen significant improvement on private capex already. It is more granular in terms of smaller capex, and we'll see the bunching up of large capex coming in now. And I think that will be key to monitor for the next 3, 4, 5 years. We are very comfortable about 15 to 20% growth in overall spending.
Okay, perfect. All right. Okay. So then, which are the sectors which are expected to benefit directly from the increase in government spending on infra?
Yeah, so as I mentioned, the national infrastructure pipeline gives you a very good framework from the government side. It gives you a perspective where they want to allocate more resources and gives even the private sector a good idea about how they can participate in that spending. I think very clearly transport infrastructure, where India wants to reduce logistic cost by half, almost half of what we are today. That will be one important factor. Energy transition again is another important factor, like the renewable investments and even the hydrogen initiatives being taken, including battery setups and all. So those are the areas which will see important spending from the government side. We will also have some balance between social obligations and political compulsions, as you may call it. So we will have the spendings on water, you will have the spending on housing from the government side. I think this will continue, and COVID also given you an enough reason to spend on healthcare infrastructure. So these
Right.
are the 4 5 key areas from the government side where we believe there will be good opportunity for everybody to participate in the growth.
So with inflation going up and with interest rates, if the interest rates were to go up from here,
Sure.
will this reduce the pace of the infra theme that we're looking at? I mean, in terms of
No,
growth.
I totally agree on that part. One of the key factors for a conducive environment for capex cycle is availability of finance and reasonable cost of financing. As of
Exactly.
today, I think we still have a space for having good reasonable angle. We are still at the uptake of a rate cycle. We are not in the last leg of it. I think there is no doubt in our mind also that we are at the bottom of the rate cycle and we'll see an upticks. Unless we have a very, very sharp action from the government side or basically the RBI side, where you have say 300 400 basis point of sharp uptick in rates going up in a very short period of time, there could be some pause, that because people will have to reevaluate their projects. I mean, what happens to the increased cost of capital? But I
Yeah.
don't think we are in the situation today. We are still in the balancing act. We want to get the economy back on our feet, and government intention or RBI clarity is there in terms of no sudden shocks in the space.
So I mean, so you don't see that impacting infra theme in a big way in
No,
the near
no, as
future.
of now, we have enough headroom, and I think there are more conducive factors. Global liquidity, domestic liquidity is still okay, and the rates are still at the early stage of a upcycle, and we have enough headroom even now left.
So even in terms of merchandise exports, if we see they touched about $400 billion in this financial year, and the momentum is expected to remain the same next year as well. So will that
Yeah.
have a positive impact on the infra theme then?
Yeah, so I think, as I mentioned, the production link incentive is a very critical aspect of government support. And we want to improve our competitive positioning, not only on products but even on technology side. I think that is very clear indication from the government side. I think the stage is set for manufacturing to make a comeback in India. How much we are able to take out from this opportunity is a question which will depend upon how well we are able to manage our competitiveness, and for that your basic infrastructure has to be improved. So we saw benefit of China plus one in some segments, like chemicals, like even autos, and even pharma. But I think it's a more broader context which can play out. Geopolitical things also make an impact, and we will see some negative also possible with what is happening today in some part of Europe and eastern side of Europe. So there will be some repercussions, but overall we see India getting a bigger opportunity on manufacturing side. We see government incentives there in place, and what is important is we definitely have the capabilities to come up. uh, you look at our talent pool in terms of demographics, in terms of English being a key language, our ability on the engineering side, on the IT side, all those are very good combination from a long term perspective. Just to give some facts, the largest R&D centers of global engineering companies, whether you take General Electric, Siemens, Honeywell, ABB. Even the ABB yesterday inaugurated one of the largest centers they have globally in India.
Yeah.
So they're already getting the benefits of engineering skill sets, and I think it's a matter of time we take it up to our production levels and become a major production hub.
I mean, also with I think with the China plus one policy, I mean, I think that would have an impact on Indian manufacturing in a good way, right? So
Sure, absolutely. I think we already seen positives on chemicals and pharma space, and to an extent on autos. If we get this energy transition right in terms of developing those skill sets or the capabilities in India, we could become good manufacturing hubs for most of the high-end technologies also.
sure. Okay. Okay. Now, for you as a fund manager, how easy or difficult it is for you to pick stocks for the infra theme, right? I mean, if you look at sectors like real estate or which are all these related sectors, they face
Yeah,
issues of corporate governance and higher debt
absolutely.
and all of that. So then,
Yeah.
for you as a fund manager, how easy or difficult is it to pick stocks for an infra theme
Yeah.
fund?
First of all, we have a great team. So we have a very strong investment team, almost like 30-member team. Very clearly defined coverages. And active coverage means everything done in house, right from modeling to meeting companies on a regular basis and forming your view. So I think that helps a lot. As I mentioned, this is a volatile space. We have to accept it. It is a cyclical space, and you can choose to add more cyclicality or volatility to it by being much more aggressive. If you get the cycle right every time, you probably make that extra return. But our focus is to try to balance that volatility. So as I mentioned, we'll be very careful of small cap exposure in particular, because there the liquidity dries up. If the market turns against you or the cycle turns against you, the liquidity just dries up in those stocks. So we'll be very, very careful of our small cap exposures in terms of balance sheet of those companies. We'll be rarely having very asset owner kind of a model in our portfolio. Most of our large bets are net cash companies or the leader in the space with manageable debt levels. So I think that will be very important. Corporate governance, again, the space itself, we can be a bit iffy about what do you call a standard corporate governance. But effort will be to ensure that we don't have companies who are outright known to be culprits on this space. And I think that is where we're trying to manage volatility. We may miss out a few percentage point returns in a short period of time, but I think over a longer term you can probably balance it out.
Fair. So, I mean, if an investor were to pick, companies in the infra space, then what are some of the key metrics that the investor should look at? While, I mean, no one better than you as a fund manager can answer that for
No, no,
us.
I I can probably give you some guiding principles. First and foremost, try to evaluate the ability of those companies to survive a down cycle. I think that is very critical. So basically, check the past cycles and how the company fared in it. It will give you a good sense about the management quality and the way they do business. Do appreciate that some of these businesses have an risk of time. You take projects which may go for 3 4 5 years, and not many things change in those 3 4 5 years. So how you have been able to understand business cycles and put it into your projections when you bid for businesses, that will give you a good indication about company's ability to survive a down cycle. Take measured bets with leaders. Consolidation is happening in almost every industries. The leaders get the capabilities to scale up faster, and they have better negotiating powers with vendors as well as key customers, and they can also invest in new technologies. I think that is also one aspect which can become a risk, especially in the period of next 15 20 years, where we believe there will be major transition phases for many industries. So I think these are the few factors. Maybe if you're starting off as an investment directly into an infrastructure company, better to avoid smaller names where the risk could be much higher, unless you are very confident about the capabilities of those companies.
Okay, perfect. Okay. And what would be some of the risks that we should evaluate while we are investing in these companies in the infra space?
Yeah, balance sheet I think is very critical. Whether it is asset ownership and therefore a heavy balance sheet, which is funded through debt, or working capital not being timely churned. I think those are the critical factors which one should keep in mind. Because as I mentioned, if the cycle turns adverse, these factors will play a very big role in not only you surviving and getting new businesses. So I think that is very critical, balance sheet of these companies. And I think the second factor on risk side should be the ability of these companies to take the changing environment, the fast changing environment which happens, how they can be able to adjust to those environment changes.
Fair. Okay. Now, what are some of the industries that will benefit from this increased spending on infra, and how can a retail investor smartly ride through this growth journey of such companies?
Yeah, I tried to highlight a few space. I think real estate still has a lot of room. I think defense as a sub industry, I don't think enough has been understood about the benefits which come to these companies. Just to give some idea, if your platform or your product get accepted by armed forces, what you sell at upfront, which is a capital cost, you
Right.
actually can make 2 to 3 times of that value over the life cycle of that product.
Hmm.
So that is the real money which these companies make. If you don't have a platform which can be up and running every time, today if you have problems of some of the Russian systems in Indian armed forces, you don't get the spares. What is the use of those products? So that will be the acceptance of domestic technologies on par with global standards is happening today in defense. 60-70% of budgets have been allocated for indigenous technologies. And I think this will really give them a growth opportunity for the next 10, 15, 20 years. Some of our platforms have run for more than 4 decades. So that is the kind of potential. Uh, they can easily make 20% plus ROE and they are trading at 50% discount to market valuation. So there are, I think there's good enough opportunity in defense. Again, I said about technology capabilities, whether you take automation or digitalization as an initiative, whether you take ability to do energy transition, whether
Hmm.
it is on hydrogen or EV. I mean, hydrogen as a basic chemistry is known for maybe more than 100 plus years, but to get it at a scale with the right efficiencies and cost of power, I think that is not so easy. So that is why you have limited number of people being able to scale it up. I think those are the kind of companies you can look at from a better risk reward perspective.
Well, I think all of us understand that at least when it comes to any thematic fund, the good thing is that a thematic fund is a combination of multiple sectors. And I think all of us know that sectors are cyclical in nature. So now, suppose if there's another recession that comes our way, then what would be your investment strategy in terms of sectors? Because obviously, even infra as a theme has sectors which, could may not
No,
perform well at times, like
uh,
the.
I think probably that reevaluation may be required 3 years down the line. I don't think we are in that phase where we have to worry about. Obviously, I mean, if there is a major catastrophe which happens for Indian economy, then we have to relook at our assumptions. But for the current set of understanding, I think we're at the early stage, probably the first 12, 15 months of an upcycle. And normally, I mean, given this kind of slag we have seen in the last 8 odd years, there's no real big investment which has happened in the country. So I think in those contexts, I think probably another 2 or 3 years before we start reevaluating our
Investment strategy.
thesis and our strategy. But as you pointed out, yeah, if it comes to be, we will probably move to more safer spaces like the utilities, for an example,
Yeah.
or companies who are leaders and try to avoid some of the much more smaller companies. I think that could be one strategy to balance it out. If we get more strength about the cycle, we will try to play more private capex. That could be one area to improve your positioning. So it will all depend, but to my mind, it's too early to look at another negative cycle and position the portfolio for that one.
I guess that question was more from an academic point of view because I do
Yeah,
agree
sure.
that right now we are in a more of a growth phase, not in the recessionary cycle, unless, like you mentioned, something really catastrophic happens.
Yeah.
But
So
yeah,
probably utilities, telecom could be much more stable in that context.
sure. Okay. Okay. Um, which factors do you think can sort of hinder the growth of the infrastructure in India completely? So, any economic factors that you think could, hinder the growth of the whole infrastructure?
Yeah, I mean, I think government side could be one area. I mean, if we, I think the mandates are very clear. Whatever we saw in the last elections, also in terms of state
Hmm.
election, so we have enough room for the mandate from the government side. But if there is geopolitical issues and any political issues from the government side, they still account for 75% of capex. So that could be one major risk if there's anything which, to my mind, should be reevaluated in 2024, not before that. The other factor would be very sharp, as I mentioned earlier, very sharp and changes in interest rate in a short period of time.
Yeah.
If that happens, if we see tightening of almost like 300 basis point in 6 months or something, I think that could create a pause as everybody will have to reevaluate their project outlook. That could be one factor, and I think these two will be the key factors. I think energy transition and all will happen over a period of time, so you will have enough understanding of evaluating things which are happening on the ground. But I think these two factors could be major risk.
Okay, fair. Okay, so now I think since we have a lot of investors on the call, and you spoke about your fund, so the question is, we always say that when you look in a sectoral fund or a thematic fund, they become a part of your satellite portfolio. So now,
Yeah.
if we are saying that say 20 to 30% of your equity allocation goes into a satellite portfolio, then how much percentage should go into an infra themed fund, or infra investment? What percentage of a portfolio should that
No,
be given
I
allocation?
totally agree. Thematic have its own set of risk, and you need to be able to get the cycle also right. So obviously, it will be a limited portion of any investor's portfolio. Probably, given the current state of things, and after a lull of almost 8-10 years, I think probably going towards 15% could be a good number in an overall portfolio from the space. You have enough opportunity to play for the next 4-5 years, and
Yeah,
I think, as I tried to highlight, if we get the cycle right, you'll probably make um, at least 50% better than broader market if you get the cycle right. So I think that is a potential, but at the same time, each individual investor's appetite and the limitation of 20% out, I think, is fair enough.
yeah. Yeah, because I think infra as a theme is probably one of the most famous themes that we have across all the
Yeah,
thematic
I
funds
think,
which are available.
but we have not seen the flows, at least. At least we industry has not seen the flows for now.
Okay.
I think probably today infrastructure makes a good option along with maybe banking as a revival, but
Yep.
I think that comes to my mind in terms of the thematic
Okay.
space.
Sure. Okay. So I guess we are done with most of the questions that we've got. So thank you so much, Sanjay, for joining us today, and for giving us all the wonderful insights on infrastructure as a theme. It really was a learning experience for me. So thank you so much. I do hope the investors had they learned a lot. And if you guys have any questions, feel free to mention it in the comments, and we'll get back to you with the answers. So thank you so much, everyone, and have a wonderful weekend ahead. And thank you so much, Sanjay, again.
Thank you very much. Thank you for having me.
Take care. Yeah. Bye bye. Thanks, guys.